There's a moment in October 1929 when the air itself seemed to change. You could feel it in the marble halls of Wall Street, where men in pressed suits moved with sudden urgency, their footsteps echoing against stone that had witnessed fortunes built and destroyed. The autumn light filtered through tall windows, casting long shadows across trading floors where voices rose in desperate chorus. What they didn't know, as they clutched their papers and made their calls, was that they were living through the same pattern that would return again, inevitable as seasons, mathematical as gravity. 80 years later, in glass towers that scraped different skies, other voices would rise in that same desperate chorus. Different faces, different technology, but the same pattern unfolding with mechanical precision. The air would change again, the shadows would fall the same way, and once more, those caught inside the machine would wonder how something so devastating could feel so familiar. Here's what haunts every economist who studies these moments. The crashes of 1929 and 2008 weren't random events or isolated failures. They were expressions of a deeper pattern, a rhythm built into the very structure of how markets breathe and grow and collapse. This pattern doesn't care about decades or technological revolutions. It doesn't distinguish between railroad stocks and mortgage securities. It simply repeats, patient and persistent, waiting for the right conditions to emerge again. The Dow Jones Industrial Average climbed six-fold between 1921 and 1929, rising from 63 points to 381 in an ascent that seemed to defy every law of financial gravity. By the summer of 1929, economist Roger Babson could feel the wrongness in the numbers, warning that a crash was coming, and it might be terrific. But Irving Fisher, brilliant and respected, looked at the same data and saw something different. Stock prices, he declared, had reached what looked like a permanently high plateau. Both men were staring at the same evidence. Both were products of the same rational system. Yet one saw catastrophe approaching, while the other saw eternal prosperity. This wasn't about intelligence or access to information. This was about something deeper, something woven into the way markets and minds interact when patterns begin to repeat. What they were witnessing was the mathematical inevitability of what economists now call a Minsky moment, named after Hyman Minsky, who spent decades mapping the internal dynamics that make stability itself destabilizing. Minsky understood that crashes aren't caused by external shocks or unexpected events. They grow from within, emerging naturally from the very success that precedes them. Periods of prosperity don't just create wealth, they create confidence. And confidence, when it compounds over years, transforms rational investors into something else entirely. The pattern begins quietly, almost invisibly. In the early stages, borrowers can pay both their principal and interest, what Minsky called hedge financing. Everything appears stable because everything is stable, but success breeds confidence, and confidence breeds risk-taking. Gradually, more borrowers enter who can only cover their interest payments, relying on refinancing to handle the principal. The system still functions, but the foundation has shifted. Speculative financing has taken root. Then comes the final stage, where borrowers can afford neither principal nor interest, depending entirely on asset price increases to avoid insolvency. Ponzi financing, named after the infamous schemer, but now embedded in the legitimate structure of the economy itself. At this point, the system has become dependent on one thing: prices that never stop rising. By September 1929, despite Roger Babson's warnings, the underlying economy showed genuine strength. Manufacturing efficiency was improving, output per worker was rising, electricity usage was expanding. Irving Fisher wasn't delusional when he saw real growth supporting stock prices. But what he couldn't see was how far the system had drifted into speculative and Ponzi financing, how dependent it had become on the assumption that prosperity was permanent. The crash itself unfolded with devastating swiftness. Black Monday brought a 13% decline. Black Tuesday followed with another 12% drop. Over 16 million shares traded hands as the machine of confidence broke down in real time. By mid-November, the market had lost almost half its value, but this was only the beginning. The bear market continued its relentless descent until July 1932, when the Dow touched 41.22, representing an 89% decline from its peak. What followed wasn't recovery, but a kind of financial hibernation that lasted 25 years. The market didn't return to its 1929 heights until November 1954. An entire generation learned to distrust the promises of permanent prosperity. The pattern had completed its cycle, leaving behind not just financial wreckage, but a collective memory of how quickly certainty could transform into chaos. But patterns don't disappear just because they cause pain. They wait, patient as mathematics, for conditions to align again. And by the early 2000s, those conditions were forming around a different asset class entirely. Instead of railroad stocks and industrial shares, the new bubble centered on something even more fundamental: the places where people live. The housing market had always been different from stocks. more stable, more tied to real value. Houses provided shelter, existed in physical space, couldn't simply vanish like paper securities. But between 2000 and 2007, something changed. Home prices began rising not just with population growth or inflation, but with the same accelerating momentum that had driven stocks in the 1920s. US home mortgage debt relative to GDP increased from 46% during the 1990s to 73% by 2008. Reaching $10.5 trillion, cash-out refinancing became common, allowing homeowners to treat their houses like personal ATMs. The same three-stage progression that Minsky had identified was playing out again, but this time in suburban neighborhoods and urban developments across the country. In the early stages, most borrowers could handle their mortgage payments comfortably. Hedge financing dominated, and the system appeared stable, but as prices rose and lending standards relaxed, more borrowers entered who could only manage their payments by refinancing regularly, counting on continued appreciation to build equity. Speculative financing was taking hold. Then came the final stage, where borrowers with no income verification, no assets, and no down payment received loans based purely on the assumption that home values would continue rising forever. Ninja loans, they were called. No income, no job, no assets. Ponzi financing had gone mainstream, but because it involved homes rather than stocks, it felt safe, even virtuous. What nobody fully grasped was how these individual mortgages had been bundled, sliced, and transformed into securities that spread throughout the global financial system. The same pattern that had emerged organically in 1929 was now being systematically distributed through complex financial instruments that few people completely understood. When the pattern finally broke in 2008, it moved with the same mechanical precision that had characterized 1929, but across a vastly more interconnected system. The Dow fell 53% between October 2007 and March 2009. Major banks collapsed or required bailouts. Some estimates suggest that 1 in 4 households lost 75% or more of their net worth. The International Monetary Fund would later conclude that this was the most severe economic and financial meltdown since the Great Depression. But those words don't capture the deeper truth. This wasn't just another crisis that happened to resemble an earlier one. This was the same pattern expressing itself again, proving that the mathematical relationships Minsky had identified transcend specific time periods or asset classes. But here's the part that should make you pause and consider what you're really looking at when you study these crashes. The pattern doesn't emerge from conspiracy or manipulation. It grows from the most rational behavior imaginable, people responding to incentives, making decisions that make perfect sense given the information available to them, acting exactly as economic theory predicts they should act, predicts they should act. The decision made perfect sense at the time. That's what makes the pattern so insidious, so mathematically certain in its return. When Irving Fisher declared stocks had reached a permanently high plateau, he wasn't lying or delusional. He was reading the same data that Roger Babson used to predict catastrophe. But Fisher was looking at fundamentals while Babson was watching behavior. Fisher saw productivity gains and genuine growth. Babson saw the psychology of crowds transforming rational markets into something else entirely. This is the paradox that drives the pattern forward across decades and centuries. The most rational actors, making the most sensible decisions based on the best available information, create the very conditions that guarantee the next collapse. They don't mean to build a trap, they're simply responding to incentives that have been carefully structured over generations to reward exactly the kind of behavior that makes the system unstable. Here's what you need to understand about how patterns persist across time. They don't require conspiracy or coordination. They don't need secret meetings or hidden agendas. They emerge naturally from the interaction between human psychology and mathematical relationships. When success is rewarded, people pursue more success. When risk is profitable, people take more risk. When prices rise, people expect them to keep rising. These aren't flaws in human nature. These are features of how rational minds process information and make decisions. But there's something deeper happening beneath these surface behaviors, something that connects the railroad speculation of the 1920s to the housing bubble of the 2000s to whatever asset class will fuel the next cycle. The pattern doesn't just repeat because people forget history. It repeats because the fundamental structure of the system creates the same mathematical relationships over and over again, regardless of what specific assets are involved. Hyman Minsky spent his career mapping these mathematical relationships, and what he discovered was both elegant and terrifying. Stability itself becomes a destabilizing force, not because of any external pressure or manipulation, but because of how success changes behavior in entirely predictable ways. When borrowers can easily service their debt, lenders become more willing to lend. When lenders are eager to lend, borrowers become more willing to borrow. When both sides are confident, standards relax, terms lengthen, and the entire system gradually shifts toward arrangements that can only function if nothing ever goes wrong. This is how hedge financing becomes speculative financing becomes Ponzi financing. Without anyone making a conscious decision to build a house of cards, each individual transaction makes sense. Each borrower and lender is acting rationally based on their immediate circumstances. But the aggregate effect is a system that becomes increasingly dependent on asset prices that never decline, economic growth that never slows, and confidence that never wavers. By 2007, the housing market had drifted so far into Ponzi financing territory that millions of borrowers could only service their loans if their homes continued appreciating not slowly, the way real estate had historically appreciated with population growth and inflation, but rapidly enough to provide equity for refinancing every few years. The entire system had become dependent on a mathematical impossibility: prices that rise faster than incomes indefinitely. What made this particularly dangerous was how the individual mortgages had been transformed into securities and distributed throughout the global financial system. Banks that had never made a housing loan in California found themselves exposed to California housing prices through mortgage-backed securities. Insurance companies in Europe discovered they had bet their solvency on the continued appreciation of homes in Florida and Nevada. The pattern that had once been contained within specific markets or regions had become systemic, woven into the basic infrastructure of global finance. When housing prices began to decline in 2006, the effect rippled through this network with mathematical precision. Borrowers who couldn't refinance began defaulting. Securities backed by those mortgages lost value. Banks holding those securities faced capital shortfalls. Credit markets froze as institutions realized they couldn't assess their own risk exposure, let alone anyone else's. The pattern that had taken years to build unraveled in months. The pattern revealed itself twice in our lifetimes, and it will reveal itself again, not because anyone designed it that way, but because the mathematics of human behavior create the same relationships across decades and centuries. The system never set out to trap anyone, but it never learned how to let anyone out. Each crash teaches the same lesson that gets forgotten by the next generation of rational actors making rational decisions in an irrational structure. If this changed how you understand the quiet mathematics that shape our world, there are deeper patterns waiting to be discovered.